Our guest this week is Morgan Housel. Morgan's a partner at Collaborative Fund and the best-selling author of The Psychology of Money and his new book, Same as Ever. He's an award-winning columnist from his days of writing for the Motley and the Wall Street Journal. We discussed what you can and can't learn from studying great investors, what surprised Morgan about moving from public to private markets, and what Morgan has changed his mind on over the years. It was a really fun conversation. Please enjoy. Morgan, I'm excited. Thanks for joining.
Good to see you, Joe. We have a long history that dates back to, I think, 2007 when we worked at the Motley together. So it's great to see you again.
We do. I always feel like when I see your book on people's coffee tables, I don't know whether to mention that we go way back because I don't want to feel like I'm a name dropper. But on the other hand, I'm like, I know that guy. And I've read a lot of his stuff, a whole lot of his stuff over the years. It's really great. How did you like the book? But I just instead awkwardly stare at the book until they ask me about it.
And you edited quite a few of the early pieces as well when I was a blogger at the Motley Fool. I think when I first started, you were an editor. You were the energy editor, I think, if I remember correctly. And in 2008, when energy was going crazy, I think I wrote a couple of pieces when I was trying to be the macro writer back then that you had your fingers on. Yeah.
It was a good start as a writer. You certainly, I think I've told you this, but John Reeves was the first person that I think I can remember who pulled me aside and was like, Joe, I've been reading this Morgan Housel's guy's stuff, and I think it's really good. I mean, I think he's really talented. So
John Reeves is if there's one person, I think I mentioned this in The Psychology of Money. If there's one person who I'm most grateful for in my entire career, it's John Reeves, who, for the people listening, used to be an editor at the Motley Fool, and he's who hired me as a writer. And when I applied, I was a college student. I was a junior in college. I had no writing history whatsoever. And he took a chance on me. And I will appreciate that forever. When you take a chance on someone who, when you make a bet on someone that you don't need to, it's a huge thing. And I'm so grateful for that.
Oh, that's great. John also gave me my first real, Luann hired me, but John gave me my first real break as an investor as well. So
that's great.
We're just going to talk about John and how much we love him for the next hour. I want to get started with a line from Psychology of Money, which is not your most recent book, but it's a great one. None of the 2,000 books picking apart Buffett's success are titled, "This guy has been investing consistently for 3/4 of a century." But we know that that's the key to the majority of his success. It's just hard to wrap your head around that math because it's not intuitive. There are books on economic cycles, trading strategies, and sector bets. But the most powerful and important book should be called Shut Up and Wait. It's just one page with a long-term chart of economic growth. Your new book is called Same as Ever. My question, what happened to Shut Up and Wait? You just heated up. And we're going in a different direction. I was a little surprised.
It's coming. That's maybe that's the next book. I'm kidding. Shut up and wait. No, I actually do. To give you a serious answer, I think there would be I've for all these things, I've just been always interested in what is repeatable. What can we actually learn from history, whether it's the history of Buffett or the history of the economy, that I can actually implement in my own life. And when you look at Buffett, you and I cannot replicate the trading environment that he had in the 1960s when he was buying blue chip stocks for 3 times earnings. We can't replicate that. He can't replicate that. But could I replicate his patience? Maybe, if I'm fortunate enough to live that long, maybe that's something that I could replicate. And so I think that actually merges as well into the idea of same as ever, like what never changes. What is something that does not rely on the specific details of a specific era that can't be replicated? And so when you look at somebody like Buffett, his patience is maybe something that hopefully you might be able to replicate. And that's why it has a particular importance when you're trying to figure out how he did it. But also maybe the point in Psychology of Money was that the reason people ignore it is because it's too simple. And there's so many big brain people in finance who have a big education and very high IQ. They can't admit to themselves that so much of that success is something as basic as he's been doing this a very long time. Is Buffett a good investor? Of course. Obviously he is. His average annual return since 1950s is over 20%. But the whole literally 99% of what made him great and wealthy is that he's earned those returns for 75 years. That's what does all the heavy lifting. And if he had retired in his 60s like a normal person, you would have never heard of him. he would have just been this recluse. Like the whole reason he's so big and successful is because he kept it going for such a long period of time.
If we're going to unpack that a little bit, there's patience, then there's repeatability. Like, to what extent do you think, or if you had to kind of tilt the scales, which way was a bigger contributor? Was pure patience or his ability to just rinse and repeat consistently on what his strategy has been?
I think it's actually the reason he's able to have endurance is because he has shifted his views, his philosophies, his investing strategies over time, from the Ben Graham net days to buying, his largest investment that in dollar terms he's made more money on than anything is Apple, to completely, if not contradictory investing styles that he has adapted and evolved over time. So it's not true to say that he's done the same thing forever. If there is a consistency, it's patience and endurance. But the reason he's been able to survive the 1950s environment, the 1970s environment, the 2020s environment is because he's adapted all along the way. And I think there are several contra examples to that of people who are very talented at trading or investing in this one era, but only that era. And once a new era arrived, they were wiped out or it just didn't work anymore. That was true for a lot of tech investors in the 1990s, a lot of bond investors in the 2000s who were very good at this very specific sliver of the market, but it was not repeatable. They could not keep it going. One other investor who I think has obviously proven skill because he's thrived in every market environment is George Soros, who has made money in stocks, bonds, commodities, bonds, you name it. He's made money in every decade going back to the 1950s. And so he has that endurance, but the reason he's been able to have that endurance is because he's changed and adapted and learned and become smarter all along the way.
I was listening to your podcast, which, by the way, it's such a flex to have a show where you host. You're the only person on the show. The show is named after you. It's so legit, Morgan. I got to tell you.
I'll tell you why I do that. I didn't. It was two reasons. I didn't want to compete with people who could interview better than I could, and it's a tough skill, and I didn't want to compete with that. The other was I don't have enough bandwidth in my schedule to create a 2-hour podcast. So it was like, okay, if there's any skill that I built up over the years, it's the 800-word blog post, which in podcast form is 10 or 12 minutes. So I'm just going to stick to that rather than trying to come up with something new and a new style, a new format. Just stick with what I've been doing forever.
It's a very good format. I enjoy this show.
Thank you.
You talked not too long ago about making a discussion around, Buffett and kind of the same points around repeatability. There was a conversation about Bezos and Amazon, and I couldn't help but think, trying to bring it back to venture, like what the current model of that is today. And I would say what's very in vogue in venture today is A16Z pioneered a very founder-first view and a platform strategy for running a venture firm. Virtually everyone is trying to run some version of that today. And it seems very challenging to me to try and out A16Z at what they're very good at, but it's not stopping people from trying. But I'm curious, as you look at venture today, how do you think about that as a strategy and how that looks? Like, obviously it's worked well in the past, but does it seem viable to you for firms that aren't of that scale to try and compete with someone who has all those resources directly head on with the same strategy?
No matter how you're investing, money is always fungible. And there's a lot of money today. So if you are a VC firm and your only value add is, hey, we have a checkbook, that's going to be a tough way to compete. There are a lot of checkbooks out there who are very eager to write money to promising companies. And so I think more than any investing style, in VC, you have to kind of make a name for yourself and a brand for yourself. And A16Z has been one of the best at doing that, about building a brand, content. The two founders are famous in their own right. And so if you are a founder trying to choose a firm, that's one you've heard of. Your parents have heard of that. Your cousin has heard of the firm. It's nearly a household name. And the value in that is enormous. I think a lot of people will view VC content as like almost an ego-driven thing. It's just like, oh, here's another VC firm on Twitter putting out blog posts. And and for a lot of cases, that is the case. But I think there's also a lot to be said for there's no way to get ahead and survive as a VC firm unless people know who you are, what you do, why you do it, what you stand for by putting out good content. And so I think there is a very legitimate strategy behind the content side of VC in a way that doesn't necessarily make sense. Yeah.
And I would encourage everyone listening to subscribe to the show as you're continuing to listen.
But I would say, does that apply to if you're running a bond fund? Probably not. I think PIMCO and Bill Gross, did a lot of content and made a name for themselves, but I don't know if it actually helped their investing performance through anything other than asset gathering, which is part of the field. But in VC, if you don't have a name, your ability to get deal flow, to even see these deals is going to be diminished. So it's not just a nice to have. It can be an absolutely vital part of succeeding as a VC firm.
What do you feel like are timeless aspects to investing in venture?
All investing is a tail-driven industry. Public equities are that, and VC is just that on steroids. And I think the tail, you see it at every layer of VC. If you make 100 investments, you're gonna, if you're lucky, you'll make all of your money on 3 of them, and 70 of them will go out of business. And it's also true that if there are 100 VC firms, all of the industry's profits will come from a few of them, and 70 or 80% of those firms will go out of business as well. So at every stage, it's a ruthless field where it's not winner take all, but it can be damn close to it. And I've always been interested from a psychological perspective what that does to people, because no one is going to start a VC firm unless they're confident in their abilities. But if you're looking at the base rate of success, it's daunting. And I think that can throw a lot of people for the loop, because no one starts a VC firm and says, I'm probably going to be one of the 80% of folks who don't make it. Nobody says that, but base rates are what they are. And so I think you have, it can throw people for a loop psychologically. Whereas if you're a bond fund manager, there's very few mega winners in that field. And there's very, very few mega explosions or firms going out of business. And so it's just a much more stable field. And particularly since we've had in the last 10 or 15 years, by and large, at the macro level, a good run of VC performance and a good run of new firms and raising money at the LP level, it accentuates people's ability to think that they are going to be one of the winners of the new entrants of new firms. And it's inevitable. There's always these statistics in public market equities that you and I spent so much of our careers in, that 90% of mutual funds don't outperform their benchmark. And sometimes that is used as an indication of, look, mutual fund investing is a scam, doesn't work, it's a ripoff, whatever it is. My response has always been, of course it's like that. What world do you expect to live in which everyone who tries to beat the market can do it? That world would never exist. It's the equivalent of like everyone who wants to make the NBA can join the NBA. Of course, that's not how it works. Only a very small number of people can do it. That's true for public investing, and I think it's just true on steroids for VC.
What do you find have been the biggest changes going from public to VC? I mean, there's right tail, there's power law, but what have been the other changes broadly that were surprising to you about making that transition?
The biggest, I don't know if it was a surprise, but just seeing how powerful it is very interesting.
Just is the scale of wins driving outcomes?
I mean, there's that too, but I think what's very interesting is that in public markets investing, a 17-year-old novice on Robinhood, by and large, has access to the same public equities that Buffett does and that Citadel does. Buffett can buy Apple stock, and the 17-year-old on Robinhood can buy the exact same stock at the exact same price. Whereas in VC, you have to earn your deal flow. And the deal flow that Sequoia is seeing is not the same that a brand new upstart VC firm is going to see. So not only is it much harder to pick the right investments, but your ability to even see all of the investments is extremely limited firm to firm. And so it's a completely different field. Imagine how hard stock picking would be if a new investor, there's the list of 2,000 public companies. And if you're a new investor, you only get to look at 40 of them. I mean, how hard would stock picking be in that world? It'd be nearly impossible. And that is by and large how it works in VC.
Well, and to use public markets as an example, a little data point I like to toss to people is that the only slice of public markets that I know of where active managers, the average active manager outperforms net of fees is Australian small cap managers.
Yeah.
And it's not because, I mean, Australians are great, but it's not because there's an outsized amount of genius on the island. It's that it's a big enough market where there's plenty to pick through, but there's not much competition. Like small caps by design are, harder, the funds are harder to scale. There's less international competition because Americans don't want to stay up late to do calls with Australians. And so scrappy little Australian fund managers, I think some people would be shocked at some of the performance some of those managers have put up over a pretty long time. And just to get to your point, I mean, even that, the information's public and there's still room to drive alpha. So if you get to a place where it's not, and there's such a wide dispersion in information, it can make for very large differences, as you can see.
I'm pretty sure too that holds up across the world, that the percentage of large cap managers who outperform is extremely low, but then the percentage of small cap managers or micro cap managers that outperform is still low, but it's higher than it would be for the large caps. It makes perfect sense. The more competitive that it is with larger companies, the harder it is to outperform. Of course, that's the way it is. And what's interesting for VC is that you're dealing with the super ridiculous small caps, micro caps, zero caps sometimes it's a pitch deck and 3 founders, and that's all you get. It's as small and tiny or non-existent as it gets. And of course, that's where the biggest information asymmetries exist, where you might potentially have the biggest opportunities. Jeff Bezos always tells a story that it took him like a year to raise $1 million for Amazon back in the 1990s. And everybody he went to said, this is a joke. It's never going to work, kind of thing. So obviously, if you can have some sort of insight or differential opinion at that level, the outcomes can just be enormous.
That reminds me of a quote I wanted to ask you about, which was, a lot of financial decisions are statistically wrong, but intuitively right for the person making them. Can you expand on that?
I think people should ditch the idea that we are or even should try to be rational. And that might seem like a crazy statement, but I just think there's so much evidence that we're not. I'm not, you're not, nobody is. We're all emotional and biased and a little bit crazy in our own unique ways, and we don't even know it. And once you come to terms with that, then I think you have to admit that a financial decision that is right for me, that is the right thing for me to do, might be not the right thing for you to do. Not because one of us is smarter than one another, just because we're different people. We got different families, we might have different social aspirations, different personalities, different risk tolerances, maybe different time horizons. And so I think that because of that, you can have financial decisions that don't make a lot of rational sense on a spreadsheet, but it's the right thing for you to do because it fits your personality, it fits your risk tolerance and whatnot. And I think a lot of financial decisions go wrong because somebody tries to do the quote unquote right thing that is not right for their personality. The spreadsheet says you should take this much risk and your asset allocation should be this, but that doesn't fit you. That doesn't fit your personality. It doesn't fit your spouse's personality maybe. And because of that, I think it's once you accept and embrace that I can do things and I do things that I can't perfectly explain or rationalize on a spreadsheet, but I could tell you why it's the right thing for me to do. It helps me sleep at night. It fits my and my wife's personalities, whatever it might be. I think that's a really important part of finance.
I feel like this ties into kind of the cycle we're in through venture, and I'm curious to get your take on it. So LPs committed $9 billion to venture funds in the first quarter, which sounds like a lot, but that's down 87% from Q1 2022. Now is objectively a better time to put capital to work, like no real question. Now, I know you could quibble around the edges, but big picture, there's much less competition, valuation is more reasonable, terms are better, access is more open, and yet LPs are putting 87% less capital to work. Yeah. How do you, and most of these, by the way, most of that capital is coming from professional allocators. This isn't mom and pops. These are people who do this professionally for a living, driving most of that. How do you view that kind of through the lenses of what you're saying about different perspectives?
I think it's always been like that in every asset class. And I think you could view it two ways. One is that they're not putting enough work. They're not putting enough money to work today, or that they're putting way too much money to work before. Or you could also say that the world has fundamentally changed and it's not as an attractive environment to put money to work for whatever reason now. I think the the simplest answer is the most likely, which is that there's just more alternatives today now that interest rates went from 0 to 5.5. There's more alternatives to put money to work. And so things are much less attractive. The alternatives are less attractive than they were 3 years ago. I think there's no question that at various points of the last decade, there were periods where too much money was coming into VC. I mean, if you just look at the number of deals that got funded, the valuations that went down, the complete and utter lack of diligence that took place at some of these, during some of these, even the big high profile investments, WeWork and whatnot. There's no official definition of a bubble, which means anyone can define it in any way that they want. But I think most people could look back at some of these eras in the last decade, not just in VC, but in tech writ large, and call it some sort of a bubble. And I think that's completely inevitable. I don't look at that and say, how could people be so stupid? How could they make these bad decisions? I think periods of excess are absolutely inevitable in markets. And the reason that is because markets are always just trying to figure out what the rest of the market can bear. What price can the rest of the market bear? And the only way that you know where that maximum price is to go beyond it. And then you could look backwards and say like, okay, that was too high. So like in public markets, what's the max PE ratio that the market will bear? The only way to find that max is to go beyond it and then look back in hindsight and be like, all right, in hindsight, 50 was too high. And if markets don't test those boundaries, there's always going to be potential opportunity there. So you have to go beyond them. And then, so like that seems pretty simple, but the takeaway from that, how that actually manifests in the real world is markets are always going to be toggling between crazy high and crazy low. They're just trying to find the boundaries of what people will put up with. It's not because people are dumb or making bad decisions or misinformed or ignorant of history. It's a completely inevitable part of how these things work. And so, yes, have there been periods of excess in VC and tech in lots of areas, of course, and there will be in the future. And I think that's going back to endurance. Like at the firm level, at the LP level, and definitely at the founder level, the question is like, can you endure those ups and downs, particularly for founders? If you raised money in 2021 as a founder off the assumption that you would be able to raise another mega round every 90 days for perpetuity, that's a tough world because there's a lot less funding now and it's with much stricter restrictions. And so that level of endurance and just fostering independence in whatever you're doing at the personal level, at the business level, the CEO level is absolutely vital. And this is where like the Venn diagram of Buffett's success and seed stage VC overlaps. Endurance of putting up with different environments.
Reminded of in the book, there's a chapter, Risk is What You Don't See. And in there you talk about there was this survey done of thought leaders in 1930 talking about what the greatest challenges were to, I can't remember if it was the US or the world at that time. And even though the Great Depression had started a couple quarters before, admittedly, maybe unbeknownst to some of these people given reporting at the time, but the unemployment came in number 18 on the list behind like prohibition was number 2. And I'm like, okay. World peace was number 6, and getting booze back was viewed as the second biggest thing holding the world back at the time. World peace was behind that, and all the way back at 18 was unemployment.
People in 1930, like we now look at hindsight and say the Great Depression began in 1929 with the crash of 1929. That's when the Great Depression began. But actually it was the Great Depression, as I think we know it today, really began in 1932, 1933, when the banking crisis happened. And that's when it got really, really bad. But as recently as 1930, even 1931, it was still viewed, even by smart top economists, as just a depression, which is what they called recessions back then. And I think the reason it didn't really freak a lot of people out yet is because in that era, particularly when the Fed was brand new, didn't really know what it was doing. For most of that era, from about the end of the Civil War through what we now call the Great Depression, there was a recession every 2 or 3 years. It was very commonplace. You're having recessions left and right, and a lot of them were bad. It was not, we have a much more stable economy today than we did for most of that period. So 1930, 1931, unemployment goes up, the stock market falls a lot. Yeah, that's how these things work. That's run of the mill. It happens all the time. It wasn't until the banking crisis of 1932, 33 that that's when unemployment went to 25%. The stock market fell 89% from peak to trough. It just got really bad. And so there's a lot of things that in hindsight make sense. And and a lot of people will say, how could people not have seen the Great Depression coming? It was so obvious in 1929, like all this excess, of course it was going to get that bad. Even in what we now recognize as the middle of it, they didn't even know how bad it was. I read this thing just this past weekend I thought was really interesting. In the 1932 presidential election, which was FDR versus Herbert Hoover, a lot of what FDR campaigned on was Herbert Hoover's massive budget deficits, that he's being reckless. Because even when FDR was campaigning, it was not the idea that we need the New Deal to fix this massive Great Depression that we're in. The idea was kind of, we're in this little recession. It's going to end eventually, but Herbert Hoover with his massive deficits is being irresponsible. So there's all of these things that in hindsight don't make any sense, that they just didn't realize what they were in the middle of.
It's reassuring to hear that American presidential candidates have been full of shit for a very long time.
Same as ever.
What is something that you've changed your mind about over the years?
I think the biggest is the idea that there is one right answer for how people should invest, or even two or three different right answers for how you should invest. I think everyone is completely different. And whenever I talk about how I invest, which by the way is very different from how you invest, I'm not disagreeing with you. I'm not saying you're doing it wrong, not in the slightest. I'm just saying this works for my personality and what you do works for yours, and to each their own. And I think most investing debates that I used to take part in were not actually people debating. It was just people who had different personalities talking over each other. And if you turn on CNBC, there'll be a guy in a nice suit who says you should sell Microsoft prior to earnings next week, whatever it might be. And I always want to say, who are you talking? Are you talking to a 17-year-old day trader? Are you talking to a 94-year-old widow on a fixed income? Who are you saying you should sell Microsoft? Everyone's completely and utterly different. But I think that it's easy to overlook that because finance is an analytical field and math is an analytical field. And in math, there is one right answer for everybody. Doesn't matter who you are or where you're from. 4 + 4 always equals 8 for everybody. And so I think a lot of the judgment that I had, not just on how people invest in money, but how they spend their money, how they save their money, the lifestyle that they live, that I used to judge other people by, I tend to be much more forgiving now. And of course, people make terrible decisions with their money. Of course, they make decisions that they will regret. But I'm much more open to others who do things very differently than me. And I think admitting that and coming to terms with that has made it much easier to justify my own financial decisions in a way that gives me and my wife a lot of peace. Just like we do these things with our money, and some people disagree with that, but it's fine. It's like we don't have to second guess their disagreements. It's just, this is what works for us, and to each their own.
How has your personal view towards risk changed over time? You were kind of an old soul as an investor. But how has that evolved?
I would say if there was an evolution, and I think you and many other people will relate to this, it was having kids. It was becoming a father. That things, as every parent will tell you, the first time you see your first child, it's like a switch goes off in your head, and the world and you, the parent, are not important anymore. This new child is the only thing that matters in the world, and of course that has an impact on how you think about risk. For me, for like a lot of people in your early 20s, money is all about like, oh, how can I become better, flashier, have a nicer car, a bigger house, better clothes. It's a very egotistical view, even if it's totally natural, and everyone to some degree falls for that. But then as you age and become a parent, it suddenly shifts towards this like, no, it's all about my family and my kids. And so I think my financial goal probably had always been, although I couldn't really articulate it, but definitely in the last couple of years that I became a parent, has really shifted just towards independence. My wife and I don't live a flashy life. We live a great life, a fine life, but not a materially flashy life.
I've seen photos of you on Instagram with the pink Lambo. Come on.
It's a leopard pink Lambo, Joe. Okay?
I'm kidding in case anyone might take that seriously.
But all I want is independence. And because of that, people might look at my asset allocation and say, maybe it's a little bit too conservative, is what some people might see. But I'm not going for maximum returns. I'm not going for maximum lifestyle. I'm going for a lifestyle that allows me to wake up every morning and say, I can do whatever the hell I want today. I don't have to do the work I don't want to do. I don't have to do it at a time that someone tells me to do. I'm perfectly independent in what I do. Now, virtually every day I wake up and what I want to do is work. So independence doesn't mean you're not working. It just means you're only doing things that you want to do. That is more important to me than anything. And it gives me more pleasure than anything that money can buy. And so I think if that's the goal, you naturally become a little bit more risk adverse. Also, because when independence is the goal, there is no risk that is worth interrupting my independence. And so that might foster a little bit of a lower risk tolerance than other people might have.
How do you think about talking to your kids about risk?
So my oldest, my son, he's 8. I've tried to, now that he's of the age where I think he can start getting these things, tried to talk to him about investing. He has a Robinhood account with a couple $100 in it. And it is in one ear, out the other. I even tried to, because there's such a small thing. I told him I will pay him 50% interest per week on his allowance if he saves it. Granted, this is on literally like a couple dollars. This is not that crazy. But I just wanted to show him how interest works. Like, here's $2. If you save one of the dollars, the next week I'll give you an extra 50 cents. I'll give you 50% per week, in one ear, out the other. Wants nothing to do with it. And so, look, of course he's 8. I'm sure he'll figure it out one day. But I think there are a lot of, Buffett talks about the money mind. Some people have the money mind and some people don't. And Munger put it more starkly. He said, when teaching money matters to young people, they either understand it instantly or never at all. And that's it. It's one or the other. You either get it intuitively or you never get it. Maybe that's too black and white. It's not quite that stark, but I think there's probably some truth to that. And I'm sure my son will figure it out someday. He's just too young, and maybe he was busy playing video games or whatever. But I think for parenting, there is some truth to it, where it's like, yes, I want to teach my kids good money values, and I want to talk to them about investing and show them how to do it right. But at the end of the day, it's their personality. And if they have the money mind, they'll figure it out. And if they don't, they won't. And that's the truth. And I think that's a hard thing for parents to understand. Like, on the nature nurture spectrum, I think a lot of money is nature. Not all of it, but a lot of it is. And I'm sure maybe that's true for you too. I think for a lot of people in investing, they stumbled into it naturally because they loved it. And they loved it because it made sense. And it made sense because it just came to them intuitively. And there aren't a lot of good investors who had to cram investing material down their throats in the way that, like when you're learning algebra in high school. Most people, that's not their passion. So they have to cram. They have to memorize the formulas the night before their test. If you're a good investor, it's not like that at all. It just came naturally to you because you understood it. So that's something that I think a lot about with money. I want to lead by example without pretending that I'm going to force insight and wisdom down their throat.
We've got 2 more questions, and then I'll let you get back to spending time with your family. The first one, whatever happened to the movie Psychology of Money? Could that happen? Is that still a thing? There were rights for it?
No, yeah, I don't think I've talked about this before ever. It's interesting. And so the backstory is, when we tried to sell Psychology of Money, the book, when I got an agent, we went to publishers. Hey, I've got this idea for a book called Psychology of Money. Every single publisher in the United States rejected it. Every single one. I think there's maybe 20 big publishers in the United States. Every single one independently said that book's never going to work. We don't want to touch it. Even when we said, like, I'll do it for no money.
Was it the title, or was it the premise of the book?
I think books are very analogous to seed stage VC, where it's like, it's actually extremely difficult to know what's going to work. So for all their reasons that I don't disagree with, it's very hard to make a behavioral finance book work. And so, but anyways, every single one of them turned it down. I eventually ended up with a publisher in London, Harriman House, who are wonderful, but because everyone in the United States wouldn't touch it. And then, so in hindsight, I like telling that story because the book did quite well. So in hindsight, it's
a good one. I like it. Yeah.
So it feels good. But after the book was published and started doing well, there's a movie production company in LA who said, "Hey, we think this is going to be great. Let's buy the rights for it." Sold the rights for it, and it was good. It was the same executive producer who did House of Cards, 50 Shades of Grey, Captain Phillips, all these big movies, who loved it. And he was like, "We can turn this into a movie. I'm totally confident." And I was like, "Great, this is awesome. This is so amazing. I don't even know what this means, but this is awesome." Very similar then to what happened with the publishers. He took the idea to all of the other big movie studios, Netflix and HBO and all those, and every single one of them turned it down. And that too, I don't fault them for it. It's not like, oh, you don't know what you're missing. It's very difficult to make these things work. So to answer your question, is it going to be turned into a movie? Almost certainly no. Maybe someday at a different point, but not anytime soon. And I think once you experience some of these things that people criticized and then it worked, and things that people criticized and it didn't work, you gain a much stronger sense of humility with every project that you take on. No matter who you are, most of the things that you work on or try to sell are not going to work. And that's okay. Yes, you really have to put your ego aside and just say, like, look, I would have loved it if this worked, but it didn't. Nobody liked it. It was a bad idea. It's fine. Let's move on to the next project. It's okay. And so that's what happened with it.
Well, that is a thing that I think a lot of entrepreneurs, when they get started, they get in as a founder and think, oh, this is going to be really exciting. You're going to get a lot of love. Being a founder is cool. It's a high status thing. And the reality is when you start any new business or venture, it's 90% plus no's. And there's it's a steep hill to climb, whether you're doing art or you're creating a software company. It's
super difficult. Yeah.
Last one, you're a voracious reader. A lot of people listening to the show are nerds. Any book recommendations for listeners who are venture curious?
I don't know about venture curious, but I'm so interested in the history of the U.S. economy, which I think any venture investor or founder should be as well. And I spoke about this a few minutes ago. This weekend, I was still am reading a book called The American People During the Great Depression. I forget who the author is, but that's the title of the book. It's always bothered me that there are very few, if any, great, groundbreaking go-to books about the Depression, which is the most important event in all of U.S. economic history by far. Not just economic history, but it completely changed geopolitics, changed the entire world. It was in many ways the seed of World War II, changed everything. And there's not a lot of great known books. Like, what's the go-to Great Depression book? I don't know. I've been looking for it. And so I started reading this book called The American People During the Great Depression, and it's wonderful. Really good. It has changed a lot of my views about Herbert Hoover, changed a lot about, like, what's so interesting about it is that the Great Depression was, yes, it was an economic event, but really it was a political event. That was really at its core, both in cause and in different solutions to fix it. And I don't like politics. I think it's dumb and gross and nasty, but you can't learn about the Great Depression without kind of immersing yourselves in the politics of the day, why they did what they did. Even something simple, the point the book makes that I had never really thought about. Herbert Hoover thought that the Depression was caused by international causes, mainly gold flows to and from Europe because of Europe's economic crisis. The inflation that they had was really screwing with gold flows to and from the United States. So Herbert's view was that's causing the Depression. So we need to come up with a solution to fix that. And FDR thought that the Depression was caused by internal problems. So he said that those are the solutions. Like, the solutions need to be fixing things internally as well. And it was just that very subtle difference between what they thought was the cause of the Depression, which is why they came up with very different solutions to it. Hoover's didn't work. FDR's maybe did after a long period of time. And so there are things like that where even if you think you understand the Depression, it was so big and so complicated that you can never stop learning enough about how important it was and how complicated and messy it was.
Awesome. Well, this was super fun. It was great catching up. Really appreciate you taking the time.
Thanks, Joe. It's been fun.
Hi, Joe again. Thanks for watching the show. If you'd like more of this in the future, subscribe to our channel. If you'd like to learn more about Seaplane Ventures, just check out seaplaneventures.com. Cheers.